Um, Welcome everybody, and thank you for joining us for the College Money Match webinar on college financial aid. We're going to talk about financial aid and go over some case studies or a case study, and I'm going to give you 10 financial aid tips that you may or may not know. So my name is David Haas. I'm a certified financial planner, and I founded Cirrus Financial Advisors in 2015. I have an MBA in finance, and actually my undergrad was in electrical engineering with a minor in economics. I'm very proud to have recently been selected as the education director for the Financial Planning Association of New Jersey. That's an organization primarily of certified financial planners, a national organization, and I'm working with the New Jersey chapter. And what I do is I help clients with retirement planning, college planning, investment management, and other things. Cirrus Financial Advisors is located in Franklin Lakes, founded in 2015. We are registered in New Jersey, New York, although we do work with some other clients from some other states as well. And I am one of the advisors, and Mike, who is also on the webinar here, is another certified financial planner and advisor. Want to say hi, Mike?
Hello, everyone. Thank you for joining us. I'll be off while David does the presentation and monitoring the chat. So feel free, as David runs through things, to type some questions into the chat. And if we find a segue while David's doing the presentation, we'll cover the questions then, or we'll take them at the end.
Yeah, very much. And right, so if everybody could put their questions in the chat when they come up, that would be great. And we will handle them as much as we can. The college financial game. And believe me, it's a game. Although it's not a game that's very easy to win, so you shouldn't think about it in terms of winning. Unfortunately, you can think about it in terms of losing. The colleges have a very high listed cost. This is particularly the private colleges, but even public colleges are starting to have very high listed list prices. They give financial aid for needy families, so that comes off the price for those families who can get it. And they give discounts. They don't call them discounts. They call it merit aid or scholarships or grants based on academic performance or sometimes some other kind of achievement of the student. But anyway, once that's all subtracted, you end up with a net price. And, some students get needs-based financial aid, some students get merit aid. You actually usually don't get both. But college pricing is kind of similar to airline pricing. Everybody on the airplane paid something different. They price a little bit according to yield, how many students they got at a particular year, how much they like you. Airlines like the business travelers better, so they often get better pricing. College has just become so similar to that. So how do you lose a little bit less? Well, you want to maximize the needs-based aid if that's possible, and we can talk about that. You want to maximize that discount or the merit aid, and we're going to talk about that. And you do both those things actually by choosing your college wisely, although there are some other things you can do as well, particularly on the merit aid. You really shouldn't go into too much debt. So debt is a trap, and that's often the finance method once you run out of all the other methods. If you do use debt, you want to use the right type of debt. And there are several types, and there's some types of loans are definitely much better than others. And you want to use your own assets wisely. You want to use all methods of payment wisely, and some of them affect financial aid depending on how you use them. And you want to understand how you're going to pay for all of college before you start. You know, if you've only solved the first year, what's going to happen the next year? So here are some important terms you might or might not have heard already. First of all, there's cost of attendance. That is the list price, but the cost of attendance should be the total cost of attendance. So it'll include tuition, fees, room and board, books, everything that the college needs you to pay for the student to attend. Then we have expected family contribution, or EFC. So this is really a needs-based financial aid term. It is calculated in a number of different ways, which we'll talk about in the next slides. And the cost of attendance minus the needs-based aid is the expected family contribution. It's the amount that the colleges expect the family to pay. And there are three calculation methods: a federal method, an institutional method, and a consensus method. So how do the colleges find out about you and find out about your financial situation? You're going to fill out two different forms, and now they're all online, of course. The first one is the FAFSA. That's the free application for federal student aid. That is a federal form that you will fill out, and it will calculate the federal method for the expected family contribution. It's available, the form is available on October 1st of each year, so of course it's available now. And you fill out that form in the fall of your senior year in high school. And the information is based on the prior year. This has changed. This changed about maybe 7 or 8 years ago, I think. So the fall 2021 admission for college, the financial aid is based on the 2019 tax return. The CSS profile is available from the College Board, the same folks who run the SAT. And CSS stands for College Scholarship Service. This is used by many private colleges and universities, and even a few public ones. And they ask many more questions than the FAFSA, and individual colleges can put their own questionnaires in the CSS profile. So one college may be much more intrusive than another one. So let's talk about how the expected family contribution is calculated for the FAFSA. This is the federal method. So it, as I said, it's used by most public colleges and some private colleges. It does not include retirement assets. So if family members have IRAs, 401ks, 403bs, those are not included. It does not include home equity, so it doesn't matter how much your home is worth. It doesn't matter how much your mortgage is. It does include somewhere between 22% and 47% of the parents' available income. So they decide what the available income is based on certain factors, including family size, and then they expect you to use a certain percentage of the income after that. The federal method also includes 5.64% of the parent's non-retirement liquid assets. So these are investments, or cash, or savings, savings accounts, whatever it may be, they're expecting 5.64% of that to be available for college every year. So it does not include the value of the business under 100 employees. So if the parents own a business and you have less than 100 employees, you don't need to worry about the value of that business for the federal method. It does include 529 plans when the parent is a custodian. This is fine though. Remember, it's only 5.64%. So a 529 plan is a great way to save for college, and I hope everybody has been using them. And it is included as a parent asset. And then for student assets, of course, they expect you to the student to pay much more. So if a student is earning money, 50% of the student's income is expected to be used over a very small exclusion amount of $6,840. And they also expect 20% of the student's assets, that's savings, investments, to be used for college. So the institutional method, that's used by most of the private colleges, and they can change the formula. So it really varies by institution. And they ask questions and include the equity in the family home. They include much more of the student's 529 plan, 25%. They're basically saying right away that you can use a quarter of the student's 529 plan for college. Even if you have a small business and that business is under 100 employees, they want to know the value of that business. So that means spending time looking at the valuation of the business. And some of the colleges ask very intrusive questions about the business because they want to find people who are basically hiding money in their business. It will include retirement savings in non-qualified annuities. So annuities can sometimes be used to hide assets on the FAFSA. It does work for the FAFSA, but it doesn't really work for the CSS schools. Non-custodial parent income and assets may be used. So this is the case of divorces. I'll talk a little bit about that on a later slide. No, there's no income protection amount for the student. So basically, the student's income has to be used for college. And as I said, there can be significant and time-consuming documentation, but it's application for college. There's lots of bureaucracy involved with that anyway. So then there's the consensus method. So a small number of elite schools have chosen the consensus method. It's called consensus because they all agreed to use the same methodology. And this includes more than the federal method, but only a bit more. So they say they're going to count 5% of the student 529 plan. They do include small businesses. So the value of small businesses is assumed that some of that could be used for college. They also assume that some of home equity could be used for college, but that is capped at 1.2 times the parent's income. And non-qualified annuities are included, which is the same as the institutional method. So at College Money Match, we offer software that helps predict the financial aid from any school. We have a database of most of the four-year colleges and universities in the U.S., many or most of the two-year schools as well. So this is an example, a case study example that I wanted to present, and it helps to illustrate a lot of the information I've been talking about with financial aid. So here we have parents. Those parents work hard and they make $145,000 a year. They have 2 children. The oldest one is the one that we're looking at for college right now. They have saved $100,000 in taxable assets. So that means non-retirement assets. Actually, to help me show this, maybe I can put a pointer out. So let's see. Hopefully that's working. Okay. Hopefully you can see this a little bit better now. Here on the bottom is where I have the information about the parents. So out of that $100,000 in assets, they have a 529 plan. I believe it was $75,000 in the 529 plan. They have saved $250,000 in retirement accounts, and they have $250,000 of equity in their home. So here's a list of schools, and we have a nice mix. We have Columbia, Gettysburg, my daughter happened to go there, Rowan, Rutgers, University of Delaware, and University of Michigan. A lot of students from this area do go to the University of Delaware, and of course the New Jersey schools as well. So, and Columbia is an Ivy. So in this column, you have the cost of attendance. So as you can see, Columbia is really up there, $84,000 now. And the lowest price of attendance is Rowan, which is actually a great school. And that one is $34,000. So the expected family contribution is in the next column, and that's been calculated in different ways for the different schools, and that's what the letters are after the numbers. So the F schools, and you see those are all the same, they're using the federal method. The I schools, they're using the institutional method, and Gettysburg and the University of Michigan happen to have the same value there, but this was fairly simple. They didn't have a business, so it is possible that that institutional amount could vary at different schools. And then Columbia, they're using the consensus method. So the EFC is $32,000 for the federal method, $32,000 for the consensus method. In this case, it's the same, but it doesn't have to be. And then a higher amount, $36,000 at the institutional method schools. So cost of attendance minus the EFC gives you the need. So the need is basically the price before aid. And as you can see, they vary a lot. And then you have the total amount of need met. So this is historically, these schools have met this amount of need. So Columbia, when needy students go to Columbia, 100% of the need is met. Rutgers, unfortunately, even though it's a much cheaper school, only 47% of the need is met. That's actually because in New Jersey, we don't fund our public universities well enough. And then the next column is how much of that need is met with grants. So financial aid can come in two forms. It can come in subsidized loans, and it can come in grants. Grants is what you want because you don't have to pay those grants back. So it's really much better if you can get your aid in grants. And now we have a forecast based on the student's academic performance, which was plugged into the school. And this is a great student who does really well. And, oh, I'm sorry. I skipped that. That's the merit scholarship. Sorry, the needs-based grants are the amount of money based on the financial aid that that this family would get. So at Columbia, they get quite a lot of money, and they get some money at Gettysburg, and they get some money at Michigan. And then the academic performance gives you the merit scholarship, And as you can see, they're getting merit money at Gettysburg, Rowan, a little bit at Rutgers, and a little bit at Michigan. Unfortunately, the needs-based and the merit scholarship typically don't stack. You get whichever one is greater. So the Gettysburg family will get $33,447 in aid, still leaving them with quite a bill to pay. And this is for 1 year. So you can actually see that the best deal here is Rowan in this group of schools. But Columbia is not that bad. And of course, you know, it's Columbia. If you get in there, you want to see what you can do to be able to go, because it's a really, really great school. So let's talk about budget. So it's really important to understand how you're going to pay for all of college before you start. It's a financial commitment for at least 4 years. There was some published information that said only 41% of students overall graduate within 4 years. I think that's a couple of years old. There are various reasons for that. Sometimes the students have difficulty, of course, but many times the students are taking co-op time or internship time. Hopefully they're getting paid for that and not having to pay tuition at the same time. But it will extend the graduation date. Rutgers, as an example, they have a published 4-year graduation rate of 64.7%. I think that's also a couple of years old. So you do not want, or you want to avoid, $100,000 plus of debt for your degree. And unfortunately, that's very possible, and I see students who have that. But my message is that your student probably cannot afford to go to college anywhere they want unless you can afford to pay. Of course, some people can. So let's take a look at 2 colleges on this student's list. And we're going to look at first at the University of Michigan. That is a great school, no question about it. So here is the net cost for the 4 years. Of course, this is a bit of a forecast. Now, remember I told you there were 2 kids. So one of the reasons why the net cost goes down, and net cost is having the financial aid subtracted. So one of the reasons why the net cost goes down is because in the school year of 2023-2024, the other child will presumably be in college. So with 2 kids in college, you get more aid, at least for this one. So with this tool, we have something called a pre-approval amount. That's basically looking at what the parents can afford to pay based on the 529, based on money that they can pay from their income, based on other savings they might have. This is just something that gets plugged into the tool to help us understand what the budget is. And that leaves a funding gap. So how do you fill that funding gap? Well, unfortunately, you have to fill it most likely with debt. And here I have pre-filled the maximum amounts that are allowable for federal student loans. There's actually a maximum each year. So once you're finished with the federal student loan, then you have a remaining funding gap. You've got to fill that somehow. And maybe that's private student loans, maybe it's Parent Plus loans, maybe it's home equity loans. That's up to the family, and certainly as a financial advisor, I can make recommendations, but it's very specific to your family. So in the end, if this student decides to go to Michigan, there's probably going to be about $110,000 of loans. So what does that mean? Well, this student here on the right wants to be a teacher. So very smart, wants to be in education. This is an estimated monthly take-home pay. The standard repayment plan for student loans is typically 10 years. So can this student really afford $1,225 per month to repay this loan in 10 years? And sure, there's a lower repayment plan for 25 years, but does this student really want to pay student loans for 25 years? So what's the other choice? So now let's take a look at Rowan, which happens to be the best school for this student. And of course, it can vary for different students. So here, the net cost is so much lower. We still have the same amount that the parents are providing each year. There is a funding gap, but the funding gap is relatively small. It can easily be filled by federal student loans. And at the end, if the student decides to go to Rowan, this student is only going to have $7,760 of loans at the end. This is fantastic. I mean, 10-year repayment, $86 per month. So to me, this looks like a great deal. Now, maybe the student gets in Columbia. It's something in between. Of course, you'd want to go to Columbia. So, it's not just financials, and I recognize that, but it's certainly financials needs to be something to be understood as part of the decision-making process. So let's get to our tips. So here's financial aid tip number 1. Always fill out the FAFSA and CSS. So there are a bunch of reasons for this. First of all, it's not just a one-year decision. And a lot of schools won't take the FAFSA. They won't look at financial aid if you didn't apply in the first year. So, and things change. So you want to, even if you know you're not going to get financial aid, fill it out. Also, you want to be eligible for the federal student loans. Even if you know you're not getting financial aid, you could get unsubsidized federal student loans. Those are actually a great deal. Even if you can afford to pay for your student, it would help to give the students some skin in the game. They might get better grades, not party as much. So knowing that they're helping to pay for college, you can always help them pay off the loans later. And filling out the financial aid forms improves your chances for merit aid. Why? The colleges aren't need blind. They may believe that they can solicit you for donations. Also, it improves the chances of admission. So if they know you can pay, they might be likelier to admit you. Tip number 2, college choice is most important. So I think we've discussed this. You want to apply to colleges that are likely to provide aid. And a great choice is an honors program at a less selective college. A lot of colleges have fantastic honors programs, and they take the honors students and they give them their own dorm and give them special perks, and they get great merit aid, and there's nothing wrong with that. So colleges are likely to give excellent merit aid when the student is in the top 25 to 33% academically. And another important factor could be extracurriculars, which could be important. So maybe your student is a tuba player. There aren't that many, and they need a tuba player for the marching band, and you might get a little bit more aid because of that. It's not a marching band scholarship, unfortunately, those don't exist, but but you still might be likely to do a little bit better in aid at a particular college at a particular time. And unfortunately, you can't really forecast that. So demographics are also important. Sometimes you get better aid from out-of-area colleges. This is particularly for the private colleges. They want a diverse student body, and that diversity includes geographical diversity. Also, if a major is a little bit less popular at the college, they want to fill the ranks for that major. So tip number 3, fill out the FAFSA early. It's available October 1st. If your student is a senior, hopefully you've already done it. If not, you should do it absolutely as soon as possible. Why? Because the students who fill out the FAFSA early could get more grant money in the aid package. So there's only a certain amount of grant money that the colleges have to play with. And with rolling admissions, they also have rolling financial aid, and they give it out. So if they don't know about you and don't know your information, they can't give you the grant money. Number 4, tip number 4: handle the grandparent help carefully. So it is wonderful when you have grandparents who are going to pay part of the college bill. The important thing to realize is that that help is considered income to the student. So remember that 50% of student income is part of the EFC for the FAFSA method. So and even more for the other methods. So you don't want to get financial aid one year and then have the grandparents help, and then the next year suddenly your financial aid is cut because they're seeing that grandparent help as income to the student. So remember that I said that the FAFSA information is prior year. So one solution to this is that you use the grandparent help only in the last 2 years of college. Another choice is that the grandparents could simply help the student loan payments after graduation. Once you're not dealing with financial aid, you really don't have to worry about anything, and the money could be gifted for that. So, so you want to be careful about this. Of course, if the student is not getting financial aid, then you don't really need to worry about the situation. This is for needs-based aid. So tip number 5, divorced families may have advantages. So FAFSA collects the information only from the custodial parent. So who's the custodial parent? It doesn't matter what the divorce agreement or the tax return says. For the sake of the FAFSA, it's the parent that the student lives with 183 or more days per year. And it's when the FAFSA got filled out. So now joint custody, maybe the student moves around a lot, maybe both parents live in the same town, kind of tough to prove where the student slept every night. So then you could play a little bit of games, perhaps, and you want to choose the custodial parent to be the one with the lowest assets and the lowest income. CSS schools, however, will collect information from non-custodial parents. So a lot of the private schools, you may not be able to play this game. And some of the CSS schools actually have agreed not to use step-parent information. So remember, there's a step-parent who may be involved as well. So the divorced parents have remarried. And whose financial information do you use? You're really only supposed to use the actual parent's information, but CSS schools will collect that information for the whole family. So here's a list of some of the schools that have agreed not to use step-parent information. The other thing is 529 plans. So a 529 plan that's owned by a non-custodial parent is actually considered income to the student when it's used. So it's treated like grandparent money. So that's something that you want to think about before you start using that. One solution is actually to change the 529 custodian to the custodial parent. That's actually considered income as well, but you could do it a little bit at a time, or just handle it prior, or treat it like grandparent money where you're only going to use it for the last 2 years of school. So tip number 6, showing interest is important. I'm sure all the guidance counselors tell you that showing interest is important for admission. It also can be important for aid, because these schools also want to give aid to the students who are most interested in going to the school. So if you want to go to a college, you might get financial aid, merit aid. This is probably more for merit aid, because the needs-based aid is really formulaic. So for merit aid, you want to show as much interest as possible. You want to participate in all the open houses. Of course, now everything is virtual, but they know who attends. Call up the admissions office, go to the open houses. Every time that you show interest, it goes into your virtual folder, and they write notes that you contacted them. Have an interview. Colleges have interviews that may just be informational. They don't count for admission. Well, even though they don't count for admission, they could count for financial aid, for merit aid. Visit the campus and make sure that the admissions office knows about it, even if they're not going to meet with you this year. Tip number 7, early action, not early decision. So you want to avoid early decision, because the student is locked in early decision. The college knows that they're not competing. That means that they also know they don't have to be as generous in aid. Early admission is often used when the college is a reach academically. So that's another issue, because the reach schools are typically not as generous, because they're less likely to really want you as a student for merit aid. So early action is great. Rolling admissions is great. For early action, you're really you're committing to apply early. That takes extra work. So that's a good point. But the college knows you can still choose to go elsewhere. So early action, early financial aid information by filling out the forms early, that is all very good for getting aid. So here's tip number 8. The federal student loans are better. They are superior. Doesn't really matter if they're subsidized or not. Subsidized are better. Unsubsidized federal student loans, the interest accrues during college, although you don't actually have to pay it until after you've completed college. But subsidized loans, there is no interest until you've graduated. So subsidized are a little bit better, but in both cases, they're good. They have excellent income-driven repayment plans. They're eligible for public service loan forgiveness. There are special forgiveness programs for teachers and nurses. You don't need a cosigner. It's just the student's responsibility. If the student is disabled, the loans can be discharged. If the students die, the loans are discharged. So they're just better. Private student loans, they vary with terms. Many of them may not discharge on either death or disability. Remember that the parent or somebody else has to co-sign private student loans. So even though the loans are in the student's name, the co-signer is still responsible. So, I mean, a terrible situation if, maybe the student dies and that's a tragedy for the family, and then they're still on the hook for the loan. It's just terrible. So for private student loans, you should look at that fact. You should always have life insurance on the student in order to pay off the loan. Unfortunately, you can't really get disability insurance until you're working, but you want to make sure that the student has long-term disability insurance once the student starts working after graduation. So tip number 9, award letters are confusing. So you're going to get, the first thing that happens is you get an EFC from the FAFSA. You get that within a week or so. And then once the college has decided to admit you, they might send you a welcome letter that congratulations, you've been admitted. The financial aid letter will come, and probably a few weeks later. There is no standard format to a financial aid award letter. It is often not clear what's a loan and what's a grant. Every school uses a different format. They may show figures for a semester, for the whole year, and they may not even show all expenses. So here's an example. This particular letter has been floating around the internet, so I decided to use it. But it points out all of the issues. So the letter shows, first of all, the cost of attendance, and it includes tuition and fees. Is tuition and fees the only cost of attendance? Probably not. There's room and board. There's books. There's all kinds of other. There's probably a student activity fee. Maybe that's part of fees. Maybe it's not. It doesn't really show. And then we have the financial aid package. So can you tell from this list even what's a grant and what's a loan? First of all, grants are financial aid. Loans are something that is really optional, even if it's a subsidized loan. You may not choose to take a loan. So showing it all under financial aid is very misleading. I can tell you that this is a federal Pell Grant, obviously. The Fed Perkins L is actually a loan. Then you have the CIOG grant, so these are all mixed up. Then you have the Fed Sub Staff. That is a loan. That is a federal subsidized Stafford loan. Then you have a college grant, so the college is giving their own money. And then you have the Fed unsub staff. So that, again, that's an unsubsidized Stafford loan. And then you have the Parent Plus loan. In no way, shape, or form is Parent Plus loan part of financial aid. Yet they've totaled it and they've made it part of financial aid. So and then you still owe money on top of that. So why wouldn't you take the rest of the money in the federal in the Parent Plus loan? Anyway, it's bad. So let's look at a good one. So this is a pretty good award letter, and this came from Pacific Lutheran University, and I picked it up off their website. So and this is long because there is good information in it, so it's in several pages. So this first page here is the cost of attendance. And it's a little bit small here. I apologize, but hopefully you can see the total cost of attendance in 2016 was $51,242. That includes the tuition and fees, housing and meals, the health service plan. They call it the wellness plan, and then they tack on a diversity, justice, and sustainability fund fee. So they are telling you that they're not including books and supplies, personal and transportation expenses, and that might increase the cost of attendance. Okay, so they don't have an estimate for that, but they're still really good about putting everything in there. So they actually used a cost of attendance to determine the aid, where I guess they did include those factors, and that was $54,800. So let's go to the next page. Now we have the grants and scholarships. So this was the middle section of the letter. So they're telling you the annual amount. They're also telling you the per semester amount. They're awarding an academic scholarship, Pacific Lutherans in Washington State. So they're getting a Washington State grant, a federal Pell Grant, and a federal CEOG grant. So they're getting, and also the students reported that there's an outside scholarship of $1,500. By the way, outside scholarships do have to be reported to the school. And they can offset financial aid, subject for a different day. Anyway, the total here is $37,120. So at the end, the student will owe $14,122 a year. That's not paid for by grants. So they're telling you, optionally, you can use loans to pay the net cost. And they're giving you the ability to take a maximum federal subsidized loan of $3,500. That's the maximum for freshman year. And unsubsidized loan of $2,000. That is totally up to you. And a Parent Plus loan of $4,000. So that's how they're suggesting you can come up with the $9,000, $9,500 using those loans, and then you can still pay cash of $4,622. And they're suggesting federal work study. So that is great. That needs to be approved by the school. So they're not including it in the aid, but it is actually a form of aid. So my last tip is number 10. You can appeal the award letter, and you typically would appeal after the award letter. Now, this COVID situation that we're in now is frankly unique. We've never had this before. And some college admissions counselors are saying that you should talk to the financial aid office before, if your situation changed from 2019. So I am not sure. I think it may vary by school, so it's worth a try whether they want to talk to you before they've processed your financial aid, or whether they just will tell you appeal afterwards. Either way, you can appeal afterwards. So if your situation's changed, you can appeal. And the real trick about the appeal is you have to have a reason, and you should be documenting that reason. So if you're making a lot less money because of COVID, because you're furloughed or unfortunately unemployed, and that certainly happened to a lot of people, you will have to show proof of that. And frankly, a 2020 tax return will be the best proof. So you probably want to prepare that as soon as possible after the end of the year. But you may be able to show other documentation prior to that states that you're now unemployed. You got a situation with a lot of medical bills, unexpected expenses. Again, you'll probably have to show those bills. Whatever you say, they're not going to believe you without proof. So you have to show that proof along with a well-written appeal letter explaining why. One thing is that you really should know what your EFC is and what it should be. You should know what the academic performance of the student is. Even merit aid could be appealed. If the college is giving particularly low merit aid, you could appeal that, and based on the fact that you know that the college typically gives more merit aid, And colleges, they don't particularly like to bargain or bid for the student against each other. But if you really want to go, I'll pick Gettysburg and Muhlenberg because students often who apply to one apply to the other one. So maybe you've applied to Gettysburg, and they're giving you $5,000 in merit aid. You applied to Muhlenberg, and they're giving you $10,000 in merit aid. But the student really wants to go to Gettysburg. Appeal? Why not? There's really no reason why not, and you could actually use the Muhlenberg Award as the reason why, and it might work. I've certainly heard that it's worked in the past. So I'm done with this part of the presentation. I just want to talk a little bit more about our college money match service. So what you get with that is you get a software with a college database that includes financial aid information on most U.S. 4-year and 2-year colleges. It is really an amazingly useful tool. It lets you search colleges on all kinds of different criteria. It has academic information on the colleges as well. It lists every merit scholarship that the colleges have given out, what the criteria are for them. So it is amazingly useful information. The software allows you to track aid awards once you get them. It has tools for forecasting your budget. It collects all the information that you need for FAFSA and CSS in one place. So once you've actually used this tool and entered all the information, filling out the FAFSA and CSS are much easier. I won't say they're trivial. The FAFSA is pretty easy from that information. CSS can still be challenging. And you get coaching from certified financial planners every step of the way, either myself or Mike. The pricing, it's all very above board. Our basic service is $700, and it includes the use of the software until your student graduates from high school. So if the student is for instance, a junior now, you could actually sign up and use it. And actually, there's 2 payments. There's $500 up front and $200 in February of senior year. So it also includes 2 hours of coaching by a certified financial planner. That's not in one shot. It's actually 3 different coaching sessions. Extra coaching is available, and we also have an extra cost service for actually filling out your FAFSA and CSS. So you can find out more information on collegemoneymatch.com. And I have a disclaimer. So basically, this was educational information, not investment advice, because we are investment advisors. And everybody's situation is different, so you really have to consider your own situation. The information here is presented on generally available information, and we believe it to be accurate, but cannot guarantee it. And on our website, you can see more information about us and our SEC filings. So now I'd be happy to take questions.
All right. Thanks very much, everybody. Thanks, David. Going back to, we have a question about slide 10, the one that listed all of the comparative list of all the colleges and the aid.
Okay. Should I go back to that slide?
It might be helpful if you could, if we could look at it.
Sure. There we go.
There we are. So the question is, Rowan looks like a really good deal, and the question is Rowan typically generous with merit scholarships?
Well, every school is generous with merit scholarships depending on the student. So, except for Ivies. Actually, Ivies don't have merit scholarships. So the Ivy schools will only supply needs-based college scholarships. So based on the software tool, Rowan is actually very generous for this student. $16,000 a year of merit scholarship is excellent. And so I'd say the answer is yes.
But of course, dependent on, how well the student performs academically.
Yeah, absolutely.
Yes.
Totally dependent on the student. And, this is a forecast. It's not guaranteed. Any given year can be different for all kinds of reasons.
Sure. Next question, can a 529 plan held by a grandparent be used to pay a student loan?
No. Well, okay, so the answer is yes, of course, because a 529 plan is just money and can be removed. But it is not a reason, I do not believe that it is a reason to waive the 10% tax penalty on earnings, only on earnings.
So the 529 plans have this concept of a qualified expenditure.
That's right.
So if the 529 plan was used to pay a student's tuition, that's a qualified expenditure. If you use it to pay a student loan, it's not a qualified expenditure, and that determines whether or not the income that you've earned since the money's been in the 529 would be taxed when you take it out.
Correct. So 529 plans are pretty flexible. Actually, so a 529 plan that's custodied by the grandparent and is assigned to one student could actually be reassigned to a different student. So that's one important thing to realize. Even to anybody. I mean, you could assign it to the grandparent themselves if they want to go back to college. I took college courses in my 50s, so and I guess theoretically I could have been a grandparent.
Okay. The other question is more general. Will PDFs of the slides be available to the participants?
Yes. I will, assuming we have your email address, and I think we did request that, I will send a follow-up email, or Christine, who works in my office, will send a follow-up email with the slides and also a student loan comparison guide that we've prepared. So you'll get that information.
Okay. And speaking of student loans, another question is, do universities give or suggest student loans?
Well, universities, so the answer is yes, they do. Universities are in charge of determining whether you get federal subsidized student loans. That's up to the financial aid office in the university. And there can be state loans that may also be available only through the university.
All right. It looks like a few more messages are being typed in. Why don't we give them a chance to come in? Here's the next question. Can we ask for grants from certain foundations which are meant to assist students? Sounds like a private scholarship kind of thing, maybe?
Yeah, that's an outside scholarship. And absolutely. The one thing is that an outside scholarship does affect your aid if it's needs-based aid. And that's actually kind of by law. So the college will reduce your quote unquote your aid. Now, some colleges may reduce your grant aid if you get an outside scholarship. What a lot of colleges do is they'll reduce your subsidized loan, or the loans part first, and reduce the grants later. So then the outside scholarships are okay. You are supposed to report, and the colleges will ask about outside scholarships.
Okay. A few other messages were being typed in. Let's give them a second to come in. Is the parent's payment tax deductible?
There are.
Sorry, go ahead.
Yeah, there are tax benefits, which all have income limits on them. So the answer is maybe. There is actually a great tax credit program called the American Opportunity Tax Credit, where you can get a $2,500 tax credit when you pay tuition, and I believe there's some formula. It's not one for one. I think it's the first $1,000 maybe. I actually don't remember. I'm sorry. Or the first $1,500 is one for one. If you pay $1,500 of tuition, you get a $1,500 credit, and then the others are 50%. So I think it works out to get the full $2,500 tax credit. I think you have to pay about $4,000 of tuition, but I may not be remembering that exactly right. I'm sorry, I don't have that on the top of my my mind. But the income phase out for that is $160,000 for married filing jointly, and $80,000 if you're single. And yes, there's a tuition deduction as well, but I think the phase out is at a lower amount for that, and I don't recall. I'd have to look that up.
Okay. Question about the student. If a student opens their own bank account, is there a threshold not exceed to avoid reducing their financial aid?
Yeah, it was that $6,840, as I recall, that's in one of the slides. Anything above that is going to be able to be used, and that's for a FAFSA school, is going to be assumed 50% of it could be used for tuition. So, one thing I should say, and I think that it's important to say this, you want to get financial aid, needs-based aid, but not every student is going to get that. So if your student is not going to be getting needs-based aid because maybe you make too much money, you don't really need to worry about those details because it's not an issue. If the student is going to get needs-based aid, then yeah, that's probably something to look at. The assumption is if the student is earning money, then the student is earning that money to pay for college.
Okay. That looks like the last of the questions that I see here.
Okay. Yeah. And by the way, well, I was going to say something about student retirement plans, but student income counts highly. Student assets also count. Remember that students can have retirement plans, but the money that goes into the retirement plan may or may not also count as income. So that's probably advice that needs to be specific.
Okay. Yeah, depending on the student's student's particular circumstances. Sure.
Right. Yep. Okay.
All right.
I guess we're 5 minutes over, but I hope everybody has enjoyed this and learned something, and I will be contacting you with the slides, and please feel free to reach out, and I would be very, very happy to give a demo and consultation with the tool so you can decide whether it'll be useful for you.
Great. Thanks very much, everybody.
All right. I'm going to stop the recording.